I want to begin with the point that most financial commentary misunderstands at a very deep level. When people argue that the petrodollar system is coming to an end, they usually focus on BRICS countries, on China making oil deals outside the dollar, or on Saudi Arabia accepting alternative currencies. Those developments are real, but they are not the root cause. They are effects, not the underlying driver. The petrodollar system is not being broken apart from the outside. It is slowly unraveling from within. And the reason it is unraveling tells you exactly where capital is likely to move next, including into a region that most American investors have barely considered seriously for the last 6 decades. If you have money in a 401k, in equities and bonds, or in savings you expect to rely on in retirement, this transition may be the most important structural financial story of the coming decade. Not because it guarantees collapse, but because it signals a lasting and meaningful shift in where value is preserved and where new value will be created. And the investors who understand how this mechanism works will be positioned very differently from those who do not. So let me walk you carefully through what is happening and why it matters. I have spent decades examining how monetary systems evolve and eventually transition. And what I have learned is that the biggest shifts almost never announce themselves in a clean or obvious way. They unfold gradually and then all at once. The people who recognize them early, who understand the machinery beneath the headlines rather than just the headlines themselves, are the ones who protect and expand wealth through the transition. Everyone else adapts only after the move is already underway and usually pays a heavy price for being late. That is where the petrodollar system is today. It is in the slow-moving phase of transition, and I want to explain exactly why, because the usual explanation is incomplete in a way that pushes investors toward the wrong conclusions. Most commentary presents the weakening of the petrodollar as an outside attack. BRICS countries settling trade in local currencies, China arranging yuan-based oil contracts with Gulf producers, Russia and India conducting energy trade beyond the dollar. Those are genuine developments, and they absolutely matter, but they are not the cause. They are downstream consequences of a deeper structural shift. The real cause is this: the petrodollar system was built on a very specific deal. In 1974, after the oil shock and after the Bretton Woods gold system had already collapsed 3 years earlier, the United States struck an agreement with Saudi Arabia. Saudi Arabia would sell its oil exclusively in U.S. dollars and recycle those excess dollars into U.S. Treasury bonds. In return, the United States would provide military protection, strategic security, and political backing. Other major Gulf oil producers followed that model. What that created was a built-in, non-negotiable global demand for U.S. dollars. Every country that needed oil, which effectively meant every industrial economy in the world, had to maintain dollar reserves. And the most efficient place to store those dollar reserves was in U.S. government debt. That structure financed American deficits for half a century. It gave the United States what economists often describe as an exorbitant privilege, the ability to borrow cheaply in its own currency on a massive scale from the rest of the world, without suffering the inflationary consequences that would normally come with that kind of borrowing. Now, here is what has changed, and this is the part that most analysts still do not state clearly enough. The United States is now the largest producer of oil and gas in the world. It has overtaken both Saudi Arabia and Russia. It is a net energy exporter. The original logic behind the 1974 arrangement, that America needed Saudi Arabia to stabilize energy supply and secure the global oil market, no longer exists in the same form. The incentive to enforce that old arrangement has shifted. The U.S. no longer has the same strategic need to protect the Hormuz corridor, to maintain the Gulf as a permanent military priority, or to align its foreign policy around Middle Eastern energy security in the same way it once did. Not because America has become isolationist, but because the math of its own energy position has fundamentally changed. And when the enforcement incentive weakens, the system that depended on that incentive begins to loosen. Not instantly. These transitions unfold over years, but once the direction is set, the trend becomes clear. What you are seeing in the Middle East right now, the higher tolerance for instability, the strategic repositioning toward the Western Hemisphere, the increasing distance from the old Hormuz-centered calculus, is not random confusion. It is what a system in transition looks like while it is transitioning. Now let me explain what that means for your portfolio. More specifically, the petrodollar recycling mechanism was the main structural source of demand for U.S. Treasury bonds for the last 50 years. Foreign central banks, sovereign wealth funds, and oil-exporting nations held dollars because they had to, and they placed those dollars into treasuries because treasuries were the most efficient way to store dollar reserves. That constant demand kept Treasury yields lower than they otherwise would have been. Lower yields meant lower borrowing costs for the U.S. government. Lower government borrowing costs flowed through to the whole economy. Mortgages, corporate borrowing, auto loans, and countless other forms of credit across American financial life were built on that lower rate foundation for decades. When that structural demand for treasuries weakens, and it is already weakening in measurable ways, yields must rise to attract the buyers who remain. And when yields rise against a federal debt burden approaching $40 trillion, the cost of servicing that debt climbs quickly. The Congressional Budget Office has already projected that within this decade, interest payments on the federal debt will exceed the defense budget. That is not an abstract theory. That is simply the arithmetic of the path we are on. For investors who hold significant bond exposure, and many people in their 50s and 60s carry a substantial amount of fixed income in retirement accounts without fully appreciating the risk, this becomes the central issue. So it's this long-duration bonds are especially vulnerable. When yields move higher, bond prices move lower. A bond portfolio that seemed conservative and secure during the low-yield environment of the last decade looks very different in a world where yields are rising for structural reasons, not just cyclical ones. And I want to make that distinction very clear. A cyclical rise in yields happens when the economy overheats, inflation runs hot, and the Federal Reserve raises rates to cool things down, only to lower them again when growth weakens. We have seen that pattern many times, including in the years following the Volcker era of the early 1980s. Those cycles can be managed. You hold through them, you wait, and eventually the cycle turns. A structural rise in yields is something else entirely. It happens when the long-term buyer base for an asset is permanently smaller than it used to be. When the petrodollar recycling mechanism served as the marginal buyer of U.S. Treasuries for decades, and that mechanism is now shrinking, you do not automatically get relief just because the Federal Reserve decides to cut rates. Now, the buyer base itself is contracted. The yield has to adjust accordingly to make up for that loss. That repricing can take years to fully unfold, but the direction is not ambiguous. That is the environment we are moving into, and it shapes everything else I want to discuss. Now, let me move to the part of this story that I believe most investors, including many sophisticated ones, still underestimate. The United States is in the middle of a strategic pivot, one that may be the most important geographic reorientation of American economic and military posture in generations. The direction of that pivot is inward and southward, toward the Western Hemisphere, toward shorter supply chains, and toward resource partnerships that do not rely on contested maritime routes thousands of miles from home. You can already see evidence of this in Venezuela. The political and economic pressure placed on the Maduro regime, the reopening of conversations around energy investment, and the recognition that Venezuelan heavy crude is precisely the type of oil Gulf Coast refineries were originally designed to handle. None of this is accidental. Venezuela holds the largest proven oil reserves on the planet. If trade relations with the United States were normalized, that resource base would become a major strategic asset for American energy security, one that reduces dependence on Middle Eastern supply routes in a fundamental way. But Venezuela is only the opening chapter of this larger story. There is another place just 90 miles from the coast of Florida that contains deposits of the very minerals that will shape which countries dominate the next 50 years of technological and military power. And most American investors have barely thought seriously about it for decades. Cuba. That may sound surprising, so let me be exact about the economics. The modern global economy depends on a narrow set of critical minerals. Cobalt is essential for battery cathodes. Nickel matters for electric vehicle drivetrains and stainless steel applications. Copper is required for every electrical system, every data center, every EV charging network, and every major renewable energy installation. Rare earth elements are crucial for the permanent magnets used in wind turbines, electric motors, and advanced military systems. These are not optional materials. They are the physical foundation of the AI economy, the electrification economy, and the defense technology economy, all of which require them in enormous and rising quantities. Cuba is the fifth largest producer of cobalt in the world. It holds some of the largest nickel reserves in the Western Hemisphere. It also has meaningful copper and rare earth potential, and almost none of those resources have been developed anywhere near their productive capacity for one very simple reason. The country has been isolated from international capital markets and modern mining investment for more than 60 years. Now, place that fact into the current strategic context. China controls roughly 60% of the world's rare earth processing capacity. It has spent years locking up cobalt supply through investments in the Democratic Republic of Congo. It has pursued nickel aggressively in Indonesia and the Philippines. The competition over critical mineral supply chains is the defining resource struggle of this decade. Not oil, because the United States now produces oil in abundance, but the materials required to build the technologies that will define economic and military strength for the next half century. A normalized Cuba with American and allied capital flowing into an underdeveloped mineral sector, with U.S. firms building out port systems and processing facilities that the embargo prevented for decades, would not be some geopolitical side note. It would be a strategic asset in a competition that China has been gaining ground in for 20 years. The recent sequence of developments is worth watching carefully. Pressure on Venezuela's government, which served as Cuba's primary energy supplier. Financial isolation directed at Iran, another important economic supporter of Havana. These moves systematically weaken the external support systems that help the current Cuban government remain outside the international financial order. Viewed structurally, they look like the preparation of conditions for change. I am not making a precise forecast about timing, and I am not claiming to know the exact form that change will take. What I'm saying is that the strategic logic of a Western Hemisphere pivot combined with the critical minerals contest against China and Cuba's underlying resource base points in a coherent direction. And history shows that these kinds of situations often attract capital before the political story is fully resolved. Venezuela's oil drew investor attention before its political future became clear. Investment in Eastern European infrastructure began before the Berlin Wall actually fell. That historical pattern suggests that patient positioning before the obvious moment is often where the largest returns are captured. Now, let me bring all of this back to what it means in practical terms for your financial position. The transition I'm describing away from a dollar system supported by petrodollar recycling and toward one supported by domestic energy production, Western Hemisphere resource access, and a reshaped supply chain geography is a transition in where value is both stored and created. And that has direct implications for major categories of assets. Dollar-denominated fixed income, including treasury bonds, investment-grade corporate bonds, and any long-duration fixed-rate instrument, faces structural pressure as the demand base that suppressed yields for half a century continues to contract. I am not saying these instruments become worthless. I am saying their expected returns over the next decade look materially worse than their long-term historical averages, and their risk may be considerably higher than most retirement models currently assume, the dollar itself is likely to face ongoing pressure, not a sudden collapse. The dollar remains the world's dominant reserve currency, and that status will not disappear overnight. But the most probable path is a slow, persistent decline in purchasing power relative to hard assets, because the structural support for global dollar demand provided by the petrodollar system is gradually weakening. What the dollar buys in real terms in energy and metals and food and services is likely to continue eroding. Hard assets tend to benefit in exactly this kind of environment. Gold has fulfilled that role in every monetary transition I have studied. When Bretton Woods broke apart in 1971 and the dollar was no longer convertible into gold, gold moved from $35 an ounce to more than $800 by 1980. Not because the world came to an end, but because the monetary anchor that had held its price down for 25 years was removed. The petrodollar system acted as a secondary anchor. It created artificial demand for dollars, which in turn helped suppress the prices of hard assets more than they otherwise would have been. As that anchor loosens, the same dynamic begins to operate again. Mining equities, especially those with exposure to the critical minerals I mentioned, cobalt, nickel, copper, and rare earths, appear to be in the early phase of what I expect will be a multi-year repricing. The demand outlook for those materials is not speculative. It is embedded in the physical requirements of electrification and AI infrastructure expansion. But supply takes years to build. That tension between demand certainty and supply limitation has historically been one of the clearest setups for patient investors seeking large returns. Infrastructure and construction exposure tied to the Western Hemisphere also represents a long-duration opportunity. The companies that build ports, processing plants, energy systems, and industrial networks for a reshoring American supply chain are not short-term trades. They are positions aligned with a structural redirection of where American capital is deployed and where American economic relationships are rooted. I want to leave you with one final observation because I think it frames this whole discussion correctly. Every major monetary transition in history has produced a significant transfer of wealth, not because some people are evil and others are helpless, but because different assets preserve value in very different ways during transition periods. And the investors who understand which assets behave which way are positioned very differently from those who do not. When Bretton Woods ended in 1971, Dr. Indectorus, the investors who understood that the dollar's real purchasing power would weaken and that hard assets would reprice in response, built generational wealth in the decade that followed. When the petrodollar system was put in place in 1974, the investors who understood that it would create lasting demand for U.S. financial assets while keeping commodity prices lower for a generation repositioned accordingly. We are standing at a similar inflection point now. The system that has shaped the financial world for the past 50 years is in structural transition. That transition will unfold over years, not weeks, but the direction becomes obvious once you understand the mechanism beneath the headlines. The investors who adjust early, who move away from the assets most vulnerable to the transition and toward the assets most likely to appreciate through it, hard assets, critical mineral exposure, Western Hemisphere resource opportunities, domestic energy, will one day look back on this period the same way long-term gold holders look back on 1971. Not as a crisis they barely escaped, but as an opportunity they recognized before it became obvious. That is the most honest assessment I can give of what I believe is unfolding right now. And here on Dalio Marco Mind, I will continue examining these cycles carefully and sharing what I see as clearly and honestly as possible. The petrodollar era created enormous prosperity. Understanding how that era transitions is the first step toward navigating what comes next.